So the budget has just dropped, Rachel Reeves has spoken, and surprise, surprise, you're paying more tax again. Let me say it exactly as it is. It's an attack on working people. It's a tax on working people. It's as simple as that. So I'm going to break down exactly what's changed, what it means for you, and most importantly, how much more you're going to be paying. Because here's the bottom line. It's clear they're not going after the rich at all, yet again. It's you that will be paying for this budget. 25.8 billion. That's how much this budget is raising by 2029 and 2030. And where's it coming from? Well, your pocket. Whether you're on PAYE, self-employed, running a business, a landlord, or saving for retirement, it doesn't matter. This hits you. And it's not just the big tax rises. They are trying to hide it with multiple hits, all stacking up, all landing at the same time for the same people. The threshold freezes, the pension grabs, the dividend taxes, there's property taxes, stealth taxes that you won't even see coming until it's too late. So let me tell you exactly how they're doing it. Let's start with the biggest tax grabs here. These three changes alone are going to be raising nearly £15 billion. So change number one, this is the threshold freezes extended. This raises £8 billion per year by 2029 and 30. Now, Rachel Reeves has extended the freeze on personal tax thresholds for another 3 years. So that personal allowance, that's the amount that you can earn before you pay tax, that's now fixed at $12,570, not rising with inflation, not rising with wages, that's frozen until 2030-31. The high band tax threshold, that's frozen at $50,270. The additional rate threshold, that's frozen at $125,140. All of these are frozen until 2030-31. Now, why does this matter? Because this is fiscal drag. As wages rise, and they will rise, at least nominally with inflation, more and more of your income gets dragged into that higher band, but you're not actually getting richer. Your real income isn't actually going up, but you're paying more tax because the thresholds, well, they're not moving. Now, they must think we're stupid because this is just a stealth tax. It doesn't make the headlines like income tax rises, but it raises the same amount of money. That's £8 billion a year from people who are already struggling. But here's the thing, these freezes were already in place until 2028. This budget extends them another 2 years. So you're now looking at a threshold freeze running from 2021 all the way up to 2031. That's a decade of frozen thresholds. Everything else, rent, food, energy, council tax, well, that just keeps going up, doesn't it? So change number two, and this is punishing those that want to save for their pension. This will raise an estimated $4.7 billion. Now, from April 2029, salary sacrifice pension contributions above just £2,000 a year will be subject to national insurance. Now, that's both for employer and employee national insurance. So let me explain what this really means. If you save into your pension through salary sacrifice, you avoid paying national insurance on those contributions. It's one of the most tax efficient ways to save for retirement. You reduce your salary, the reduction goes into your pension, and you save on both your income and the national insurance. But from 2029, anything above just £2,000 that you salary sacrifice, you're then paying national insurance on it. That's up to 8% employer national insurance if you're a basic rate taxpayer, 2% if you're higher rate. Plus your employer pays their national insurance on it too. Now, more people than ever do not have enough saved for retirement. But if you're doing the right thing, actually saving for retirement, building up your pension pot so you're not reliant on the state, now you're being punished for it. That's nearly £5 billion extracted from people trying to save for their future. And who does this hit? The middle gap again. People on okay salaries trying to build a retirement fund. Not the very wealthy. They've got their money in trusts, offshore structures. Not people on minimum wage who can't afford to save anyway. You, the person in the middle, doing or trying to do the sensible thing and being treated like a cash cow. So change number three, it's more tax on business. This raises $2.1 billion by 2029-30. So from April 26, dividend tax rates are going up by 2% points. That means basic rate goes from 8.75% to 10.75%. The higher rate goes from 33.75 to 35.75. Then from April 27, property income and saving income tax rates also go up by 2 percentage points. Now, who does this hit? Business owners who pay themselves in dividends, small company owners, landlords with rental income, anyone with saving interest. Now, this means that you pay corporation tax at 25% and then dividend tax on top. It looks like it's more tax efficient to just go and work for someone else. This isn't targeting the very wealthy. The very wealthy don't have dividends from UK companies. They just don't. Their income is structured through offshore vehicles. So this again is targeting small business owners, successful but not very rich landlords, middle-class investors, let's say. And it makes you think, why would they even bother risking starting a business if you're going to be taxed more than someone that's in PAYE? So these are the big three: 8 billion from threshold freezes, 4.7 billion from raiding pensions, and 2.1 billion from taxing dividends, property and savings. That's nearly 15 billion, but we're not done. Not even close. So let me talk about HMRC compliance crackdown, because this is something that I harp on about quite a bit. And I've been saying for quite some time, or we as a channel have been saying, that they have been becoming more and more aggressive, and they mention it in the budget. They've been sending out more letters, launching more tax investigations. And because we track our own internal metrics, we have seen this. We've seen a huge increase in the last year. And that is where it all started really with these videos, giving people a heads up. So it looks like that this is, as expected, bringing in a shed ton of money. So they're going to double down on this. They're hiring more investigators to go after you. More investigations, that's more scrutiny, that's more penalties. That tax gap, the difference between the tax owed and tax then collected, they're trying to close that as much as they can, which means more pressure on everyone. So now let me talk about the stealth taxes, because it's never just the headline announcements. It's not. It's always more. It's always the stuff that's buried in the small print, let's say. The changes that don't make the evening news, but will still drain your bank account. Now, the big one here, and this one does cut hard, slashing cash ISAs from 20,000 to 12,000. The cash ISA limit has been slashed by 8 grand, and that is just a joke. It does get worse. It's not for those over 65. Why are working people being punished more? If you're already paying tax, you're already able to save less. So that feels like a transfer of wealth from working people to pensioners. That isn't fair, not at all. We've also got electric vehicle mileage charge raises. That's 1.4 billion by, again, 29/30. So from April 2028, if you drive a battery electric or plug-in hybrid car, you're paying a new mileage base charge at 3p per mile. The government's losing fuel duty revenue because more people are switching to EVs. So they're replacing it, you being more economical conscious, they need that money from somewhere, ultimately. So if you thought getting an electric car was a good idea, reducing emissions, you're doing your bit for the environment, your reward, a new tax, 1.4 billion for all EV drivers. There's also high value council tax surcharge. That raises 0.8 billion by 29/30. Not the largest then. It is a surcharge on high value properties. And those of you that might be thinking, well, it is mega mansions, it won't affect me. Think again, because, in London or the Southeast, Band G or Band H properties could see their council tax doubled. Now, you may be thinking this doesn't affect me, but every tax starts like this, so I can pretty much bet you in 5 years or more, this mansion tax, let's say, that threshold will be dropped, and then there'll be more and more, normal everyday homes being kind of pulled into it. So next up, we got student loan threshold freezes. That raises 0.4 billion per year, plus 5.6 billion as a one-off hit. That's student loan repayment thresholds and interest rate thresholds that are being frozen for 3 years. More graduates are going to be paying back more money for longer. It's basically a graduate tax. Then there's also the fuel duty freeze extended for now, and that will freeze fuel duty for another year. It sounds good, but it's temporary. This will end, and when it does, fuel prices are going to jump. This isn't a giveaway, it certainly is a delay. We've then got other policies such as gambling duty reform. That will raise 1.1 billion by, again, 2029-30. It's changes to how gambling is taxed. It hits both operators and ultimately consumers, because the operators will pass on these costs either through, worse odds, higher charges, or both. So that's another 6 billion from all of these smaller measures. And when we add it to the big three, we're now looking at 20 billion. But wait, there's more. So let's talk about where your money's going, because it's not just about tax rises, it's about where that money's actually going, what you're paying for. So for example, the two-child benefit cap has been removed. That costs 3 billion a year by 2029 and 30. And where does that money come from? Well, that's your taxes. There's winter fuel payments expanded, reversing previous cuts. That's over 3.5 billion a year. Again, that's your taxes that pays for it. There's renewables obligation subsidy. That's the government's temporary refunding 75% of the cost to reduce energy bills. Now that sounds great. It costs 2.3 billion a year for the first 3 years. But again, it's funded by your taxes. Now, I'm not saying these are bad policies. I'm not making a political point about welfare. I'm just stating the fact. When the government spends money, it has to come from somewhere. And right now, with tax rises of 25.8 billion, it's coming from you, working people. So now let's talk about the real cost here, adding it all up. Because if we stop looking at these in isolation and see them as they actually are, how they stack, how they compound, then it kind of makes more sense. So I'm going to give you a couple of examples here. Example 1, you're a PAYE worker earning £50,000. Now, that's a decent salary. It's not mega wealthy. It's all right. So here's how this will hit you. Threshold freezes, that means your salary rises with inflation over the next few years. So that means more of it's going to get taxed at that higher 40% rate instead of 20. That's fiscal drag there. You're paying more tax just because the thresholds aren't moving, basically. That's going to cost you hundreds of pounds. Then you've got pension savings. If you're sensibly putting more than 2,000 into your pension via salary sacrifice, from 2029, you're paying national insurance on that. So let's say you sacrifice 5,000 a year. Well, that's now an extra £240. That's 8% on that 3,000. Saving interest, if you've got money in savings and you're earning interest, with the current rates, you probably do, that interest is going to be taxed at the higher rate from 2027. That's another 2% gone. Then if you do own, let's say, a home in band G or H, and you've got that council tax surcharge, potentially hundreds more per year. Now that's not one tax rise, that's kind of multiple hits, all for the same person, all at once. And we're easily talking £500 to £1,000 more per year, depending on circumstances. Now let me give you example 2. This is a small business owner, 80,000 profit, pays dividends. So clearly running a successful small business. 80k profit, you pay yourself partly salary, partly dividends. Here's again how you're hit. The threshold freezes, that fiscal drag on your salary portion, that's more tax. The dividend tax rise, 2% more on all dividends from 2026. If you're taking that 40k in dividends, that's an extra £800 a year, every year. You've got corporation tax changes, so writing down allowances reduced. You buy equipment for your business, you get less relief. Pension savings, if you're salary sacrificing again above 2,000, that's national insurance from 2029. You're being hit from every single angle. That's personal taxes up, that's business taxes up, that's investment taxes up. Pension taxes also up. This person could easily be paying an additional 2,000 to 3,000 more per year. So ultimately, across all these different groups, whether it's a PAYE, worker, business owner, landlord, someone who's savings, it's the same pattern. Multiple hits, all stacking, all landing at the same time. So let's talk about why it's always you. Because this is the pattern that we see every single time. Last time, the government said there was a 50 billion black hole and they won't need any more money. They then give the public sector, pay rises, increase welfare spending, and now they say there's another 20 billion black hole. So what they're going to do? They just squeeze out more. Do they go after the very wealthy, the billionaires with offshore structures who pay minimal tax? Well, we spoke about that in the last video, exit tax. They tried to or thought about introducing this 20% charge on wealthy people leaving the UK. It got scrapped. So the government backs down on that exit tax. They don't want to upset the mega wealthy. They can't risk them leaving. They can't risk losing their money and investment side. So again, they just go for the easy targets every single time. Last year's budget raised 40 billion. This one's raising 26 billion. And who paid for it last year? Who's paying for it this year? And who will be paying for it next year? You. The ultra wealthy will escape. They've got their money in structures that obviously you haven't got access to. They've got advisors that you can't afford. They've got options that you don't have. And at the other end, the people who don't contribute, they're not paying. You're stuck in the middle. You're funding both ends, getting squeezed from every direction. But let's talk about what you can actually do, what things you can introduce, because let's be honest, complaining about it, being angry about it doesn't change it. Being smart about it can help, and it can make a difference. So there are 3 focus points. Now, before I go on to them, I will just say, if you're a business owner, a sole trader, or doing anything outside of employment, and you think you need an accountant or you want an accountant that just gets it, then you can get in touch at any time. You can use the link below. You can also download our budget guide below and have all the information that I've spoken about and then how you can react best to the budget. So anyway, the 3 focus points. Step 1 is understanding how this impacts you, your specific situation, not just the general stuff, not the things that are going to be in the headlines. How does the budget impact your circumstances? Are you caught by that threshold freeze? Yes, pretty much everyone is who's working. Are you currently salary sacrificing into a pension above 2,000? Then you do need to plan for national insurance changes that are coming. Do you take dividends? You know, your tax rate has just gone up. Do you have any rental income? Your tax rate's just gone up. You need to understand the additional tax burden. That's the first thing. The second thing, really important now, and I do harp on about it a lot, but stay compliant, because with HMRC ramping up enforcement, with compliance measures mentioned in the budget, with a tax gap being targeted, you can't afford to be non-compliant. That means proper records, deadlines being met, because HMRC are looking for easy targets. Step number 3 is be tax efficient. Compliance isn't enough, because if you're just being compliant, you're probably still overpaying taxes somewhere. You need to be tax efficient, and I mean properly tax efficient. That's claiming every relief you're entitled to, every allowable expense, structuring things optimally, timing things in the right way, using your allowances before they disappear or get frozen. With taxes going up, tax efficiency matters more than ever. It's better to keep as much of your money as you legally can than it being pushed into this massive black hole. So that's the budget. That's what's changed. And the bottom line is simple. You're paying more. 25.8 billion more by 2029-30 coming from your pocket. The really wealthy escape once again, the welfare system being funded more. In a bit of a pickle there. So if this video has helped you understand what's actually changed, do hit that like button, subscribe for more insight like this, because we will be releasing a deeper dive video in the coming days and weeks that's related to the budget. Drop any comments in the comment section below, because I'd love to understand your thoughts, and it's always good to talk about it.